Yo, what up traders? Welcome to another video where I'm gonna tackle problems you guys have, which is picking the right dealing range to trade from. Now, a lot of you guys are struggling with picking the right dealing range, which results in your stop loss getting hit and then price moves in your favorite direction because you know order flow, but you don't know how to pick the correct dealing range. I'm gonna go through a few simple steps how to mechanically pick the right dealing range, and stick around until the end because at the end I will give you a little trick I personally use to gauge order flow on the lower time frame using dealing ranges. Right guys, let's dive into this topic, dealing ranges. A lot of people struggle with picking the right dealing range. I'm gonna go over a couple of topics here. First of all, how do you actually pick the right range? Second of all, when is it a good range? Then third, we're gonna go over higher time frame ranges into lower time frame ranges. And at the end, I got a little trick which I use, which is the D2R technique, which is double dealing range technique, is how to get in on lower time frame order flow. I've not specifically taught this anywhere but my private students, but this is a little trick I use myself to find an entry on the lower time frame. So first of all, how do we pick the right range? We're gonna go with higher time frame order flow. Let me remove this. This is the most important part. Let's go to the daily time frame. We have a gold chart over here, right? The most important part with any technique you use is the higher time frame. So if I look at this gold chart over here, just take a look at what we're looking at here, right? Mark out the PD arrays. I've got a rejection block over here because we always want to work with key levels before we start using proper ranges. With this rejection block over here, well, now we got to figure out, are we actually going to run towards another target from this rejection block, or are we going to keep pushing up higher? This is where we're going to use smaller ranges within the bigger range. So if you noticed, the entire leg up happens from here all the way up to here, right? If we want to go higher and we are rejecting a rejection block, we want to use a smaller range within the bigger range. So if you guys can spot a smaller range over here, let me mark it out for you guys. This is a smaller range. Let's make the lines red, right? We've got a little leg over here, right? This smaller range within the bigger range is what we can use for order pairing. So a lot of you guys are also questioning or asking me questions about how to order pair correctly. You always use a higher time frame range and then you use a smaller range to find order pairing highs and lows. So you got to have a bigger range and then you look within that range whatever is available to pair up with buy stops and sell stops. So we have a rejection block. So first of all, key level. Then second of all, order pairing high to low. So now we're framing with our dealing ranges, we're framing our bias here because we're in premium and we want to aim for a discount level, right? So what do we want to aim for when we're going to discount? We want to aim for a short-term low. So we got that short-term low over here. Now that we've determined our daily bias, let's go into the 4 hour. And the 4 hour, as a rule of thumb, you need to use the 4 hour as your lowest time frame to determine higher time frame bias or order flow. Don't go into the 1 hour time frame and then determine, oh, we have a break of structure on the 1 hour and now we're probably going to go bullish. You use the 4 hour time frame. Make sure you're in a market maker buy model or a market maker sell model to confirm what side of the curve you are on. Right? So rejection block on the daily here. Does it make sense that we're going to go bearish? This is where you're going to use market maker models. So if I zoom in a little bit, we know this is the daily high and this is the daily low, and we want to aim for discount below the range low, right? So if we mark out this area over here, this is our original consolidation in a market maker sell model. When you're trading a market maker model, anything that happens to the left of it over here, we are not interested in it anymore. So the trick you do, or what you should do, is zoom in and look at the chart like this. So we're only focused on this piece of price action over here from the buy side of the curve if we want to frame a setup on the sell side of the curve. Now, how do we pick the right range? Obviously, higher time frame key level, and we want to wait for price to bottom out and form a swing low. So we have a swing low here and a swing high here, right? So this is our first range. Now in a market maker model, personally, I don't like to trade the smart money reversal, which could be this one. And I don't really prefer to trade the low risk buy or low risk sell either, because it can still continue up if it decides to do a V-shaped recovery, which means it goes like this, and then the low risk sell doesn't even form here, right? Now in this occasion over here, we've got a move down, consolidation, then a manipulation move, right? So if you guys know about market cycles, if we start to consolidate after a reversal, it's not gonna go reverse again, right? That doesn't fit in the market cycles. So what you want to do is identify the low risk sell and then trade the next leg that forms out of it, right? So we've got this first range. Now we can see a purge on the highs over here. Let me remove these red lines so we have a little bit of a clearer picture. So we purge the highs over here, and then this forms the low risk sell, right? This is important to know because we can then actually focus on the next leg down. So this is the next leg, right? This is the swing high. Down here we have the swing low. So technically this is the next swing. You can focus immediately on this next swing to look for a setup. You can see price comes back into premium here and then sells off again. This is a perfect example of waiting for two ranges to form and then start to engage. That's why I call it the double dealing range technique, because the first range forms the low risk sell or low risk buy in a market maker model, and the second range or first stage distribution is where you want to aim for your entry. So now we've determined that we have two ranges, and we picked these ranges based on a higher time frame key level, right? That's why the range is good. You need a higher time frame key level, and once you start having that low risk sell formed, now we're going to focus on the lower time frame. So now we dive into the 1 hour time frame, right? So we have this still outlined from the 4 hour. Let me just remove the first range and outline that this is actually the low risk buy, right? So just call it LRB, or low risk sell rather, not low risk buy, because we're on sell side of the curve, right? So this is the low risk sell. So now we're aware, okay, we're going into sell side of the curve because we have another displacement leg down. You can gauge that you're going on the right side of the curve by the fair value gaps that are printed after you form a low risk buy or low risk sell. That is sponsorship that happens behind the move. So we can see a couple of fair value gaps here. We have one over here and we have another one here, right? So this indicates that there's sponsorship behind the move and that the PDRA is a good one for lower prices because we're following the market cycles: expansion, reversal, consolidation, retracement, and then expansion, right? So the only thing that can happen here is a retracement again, or a consolidation and a retracement, and then an expansion. So now we have marked out our dealing range. We have our fair value gaps. This could be used as your POI for looking for sells. So if you use the time frame alignment model, ideally you use a 4 hour key level into 1 hour order pairing. That's not the case over here because there's no 1 hour high to order pair. There's a 1 hour key level. There's a 1 hour fair value gap. Let's go to the 15 and see what we got over here, right? Let me narrow it down a little bit. So we're going to use this fair value gap here. And I'm going to use, to make it just a little bit cleaner, I will use this and remove this box, right? So now we can clearly see what the levels are. Purge on the highs on the 4 hour, displacement lower. Now we want to have a short-term high formed around equilibrium of the range with the time frame alignment model, and then we're souping that high, right? But in this occasion over here, we only have the highs up here. So it's not gonna be a continuation purge in the sense how you would use the time frame alignment model, but this is still valid, although being it very deep in discount of the range, it's still pairing off the buy stops above these highs here, inducing buyers as well, because we're breaking structure, so to say. But we know that we're going into bearish order flow based on that double dealing range technique on the 4 hour time frame. You could still look for an entry in the 4 hour fair value gap. You should use a wider stop loss. So let's say you would get in over here at the 50% level. You should look for an area where price should definitely not come into. So if I just look here, right, we have one up close candle, price tapped into that up close candle and then displaced away. So definitely we should not come here. So what you can do is use a conservative stop loss like this, right? And then you aim for 2R, which is around this. And there is a lot more downside. This is the beauty with trading a higher time frame key level. Obviously, you want to target a lower time frame or a higher time frame target as well. So there's these lows in the original consolidation, which we already formed, right? So if you would target this, then it would be an over a 5-hour trade. Now you got to be aware, when you trade the original consolidation of a market maker model, it's going to take a lot more time to reach. So what you want to do is look for low-hanging fruit if your order pairing ranges, which is the leg over here, right? It broke the high here, and then it formed the low. So what we're going to do, we'll look for a smaller range again inside this bigger range. So we're continuously looking for smaller ranges within bigger ranges. You want to have a dealing range that purchases buy side and sell side, ideally, with displacement. So that makes it a good dealing range. Now I've got something we're going to do interactively. This is no hindsight, of course, because if we look at the gold chart currently, can we use the same technique I just outlined as an example over here for sell side of the curve? Can we do the same thing over here for buy side of the curve? Now I want you to do that on your own, mark up the gold chart, see what needs to happen before we can determine that we're going to go into bullish order flow. And does it make sense that we're going to go bullish on gold? And this will be a great case study for you as well to check out how you determine the right dealing range coming into the next weeks on gold. Let me know in the comments if you struggle with dealing ranges and this video has helped you. Obviously, make sure to subscribe and like the video as always. I will be uploading every single week, and I will see you guys in the next video.